the whole idea of credit is how risky you are as a borrower. And so the higher the credit score, the less risky you are seen to be. The lower the credit score, the more risky.
If the credit score is kind of the foundation of an application, or yeah, or if the complexity of a loan is kind of determined on the credit score, let's start with like the easiest loan, and then let's work. Or I should say that, not the easiest loan, the one that would build your credit the fastest, and then kind of build from there. If I'm a 16-year-old kid, and I want to build my credit, or if I want to start a credit history or start thinking about my 20s. I know most 16-year-old kids don't think about their 20s, but let's assume they do. Um, where do I start? What's the easiest way to start getting my credit score in good shape?
So, you want to start with the credit card. You want to try to keep the balance low on it. And, you know, 2 to 3 credit cards, maybe if you work up to that point, it would be a good place to be. You don't want to go crazy with the amount of credit cards that you have, but you just want to be able to show that you can responsibly make payments, and credit cards are a great way to do that.
So that's kind of the entry point to the world of loans is a credit card,
I would
right?
say so. I mean, you can start with other things, but it's harder to be approved for the other things if you don't have a history of payments.
Yeah. And I think that's where I was headed with too. Like if I'm 16, I'm not going to go straight for a mortgage, right?
Right.
Kind of one of the most complicated loans to really apply for and get. So how do I start slow? I'm thinking about that even too. One thing that could help your build your credit as well is to have a checking and savings account, right? So and that's one thing you can do pretty young, at DACU, and that's one of the benefits of having a relationship, right? That builds your character.
Right.
If you have a checking savings account for a few years with us as a teen or preteen, when you get to the place where we feel you're responsible enough for a credit card, you can apply for one, and we'll allow you to come along, kind of grow in your financial responsibilities.
Yeah. Your checking account, before you have any credit, your checking account is your credit with us. Right. And so I talked about your relationship meaning a lot when it comes to a loan decision. And if you handle your checking account well, you're not constantly taking your account negative or things like that, then, it kind of shows that you are able to handle that line of credit.
Very good. Yeah. Yeah, that's interesting. I mean, like I said, I've got preteen kids, and so trying to teach them how to be fiscally responsible starts with a checking and savings account. So
Absolutely.
they can baby step into that. Nice. Okay, so we've kind of covered the credit card. So then next kind of rung on the loan complexity ladder, would you say that's a personal loan?
Yeah, honestly, I would say that personal loan and auto loan are kind of uh, back to back there. It depends on the size of the personal loan. We're not going to step out and do a $30,000 unsecured loan after you've just gotten your first credit card. But we may do $1,000 for you, $2,000 for you, depending on the reason and how well you've handled that credit card. But on the flip side of it, we may do a car for you as well. Um, really just depends on how that relationship has grown and what your credit's looking like when you come back for that auto loan.
Would a 16-year-old who applied for a car loan who has a good history with DATQ, checking savings, and credit card, is that too big
So
of a risk?
now you got to be 18 to get
Okay,
a loan.
gotcha.
Um, Simple as that. You got to be 18 to sign the contract.
Yeah, you're just trying to stick it to those parents, aren't you?
Yeah, well, if they're willing to sign, I mean, they were teaching all the life lessons up to that point.
That's true. That's true. That's true. It's always the parents' fault. No, I'm just kidding. I'm just kidding. Okay, so we've got credit cards, we got personal loans, and perhaps auto loans, kind of at the same level.
Mhm.
If we step into mortgages, then maybe a little bit later in life, what are you looking for in the program parameters for, say, a mortgage loan?
Honestly, probably more so than anything, stability. Uh, you know, we just there's so many there's so many regulations and things that are protecting or that are regulating how we can lend You know, we do everything is following the Fannie Mae guidelines. So it has to be, we're going all the way into the terms here, but it's got to be a conforming mortgage. It's got to be something that can be sold to Fannie Mae. So um, getting qualified for a mortgage is really more so about stability and affordability. You know, you don't want to get into your first house and it's $1 million house. You got to be able to afford it. But again, just like an auto loan, down payment and things like that, they really influence how much you can get there.
Gotcha. And you mentioned too, with like credit scores, it impacts your terms, right? Just as much as the size of the loan.
Absolutely.
Could you dive into that, clarify that a little bit?
The term of the loan, how long we are willing to finance a piece of collateral, could actually be determined by your credit score. So, you know, our higher tiers, a 680 and above, they can take a newer vehicle out to 84 months and take longer to pay off that vehicle, as opposed to someone with a lower credit score. We need them to pay it off a little bit quicker um, because it's a depreciating asset. And so the people that have proven that they have good payment history, we're allowing them to take this depreciating asset, and at one point it may be uh, they may owe more on it than what it's worth, but we're willing to take that risk because you've proven in the past that you're willing to make your payments. Now, that is just on the term side of it. I mean, interest rate, that's the biggest factor that comes with your credit score. You know, right now, somebody trying to buy a new vehicle, someone who has an 800 plus credit score, they're going to get, is it low sixes or so in the interest rate?
Yeah,
And
you had written out an illustration for me prior to when we were talking to, and I think your example was a $30,000 loan for 72 months. You said person A who has an 800 plus score will have a monthly payment around 506.
mhm.
Person B has a 620 score will have a monthly payment around 597.
Yeah, so that difference is about $6,000 in interest over the course of the loan. If both
Yeah,
people make all 72 payments, uh, person B is paying much more in interest.
very nice. So, and that's kind of where I think why I wanted to start with the terms. Once you kind of clarify what it takes to get into a loan, right, and then we wrap it up with credit score. That's kind of the foundation of what y'all look at, and in addition to character and collateral, right, the three
Hmm.
C's. I'm listening. I'm
Yeah,
paying attention.
it's good.
And once you have that, then you can kind of step into those worlds of credit card, personal loan, auto loan, mortgage. And it's really important for people to understand how that's a tiered thing. Like if you have a pretty difficult credit score at the very beginning, it's going to be difficult for you to get a credit card. Then if you do get a credit card and you don't handle it well, it's going to be really hard to get an auto loan and personal loan because now you've established character,
Right.
right? And then when you're ready to get a mortgage or if you're trying to get a house, if you haven't handled those first two or three things well, it's going to be really difficult to get a mortgage. Not impossible. You can get it, but it's going to hurt a little bit more because your interest rate might be a little bit higher because of your scores a little bit lower, your character hasn't been proven with payment stability, et cetera, those types of things. Is that a fair assessment? That it's kind of a not a tiered approach. I'm blinking on the word here.
Yeah, no, you're absolutely correct. You know, it takes a lot of time and a lot of effort to keep your credit score up and keep it high. I'd say effort, but it's probably more discipline. Um, but it's very difficult to increase your credit score once you've established some derogatory credit. You know, credit uh, accounts are reported to your credit for 7 years. So once you have some slow pays, as we call them, on there, where you've been 30, 60, 90 days delinquent on an account, it's very hard to separate yourself from that.
Yeah.
Time heals all wounds, though.
Time heals all wounds. How so?
Well, like I said, it only lasts for 7 years. So I mean, after the 7 years, it's going to fall off, and it's not going to show that you had that derogatory payment.
Gotcha. Okay. Um, so you can improve your score by outlasting the bad stuff.
That's one way.
Can you speed it up by doing good stuff?
Absolutely. You know, one of the biggest things that the credit bureaus are looking at, or what they're using to determine your score, is how you're using your revolving credit. You know, we talked about that a little bit earlier. You know, if you have all your cards maxed out and an emergency were to happen, you don't really have anywhere to put that emergency. So then you have to start, this is how the bureaus are thinking about it, and which forces us to think about it this way. But in that scenario, an emergency were to happen, it's a medical emergency or something like that that takes the money out of your checking account. At that point, you don't really have anywhere to put that emergency. So you go to your checking account. Now you're forced to start making the tough decisions of whether you're going to make your credit card bill payment, or whether you're going to put food on the table for your family, little things like that. So um, the flip side of that is, if you're using a minimal amount on your credit card, if you keep that thing paid off, you're kind of showing, look at how much money I have access to that I don't need. And that's huge. This whole uh, the whole idea of credit is how risky you are as a borrower. And so the higher the credit score, the less risky you are seen to be. The lower the credit score, the more risky. Well, having your credit cards maxed out is risky behavior.
Gotcha. And I think at one point you had mentioned a magic number.
30% is the magic number. I think that you want to try to keep your credit cards below 30%. When I used to sell these credit cards, I used to tell people, pretend that's your limit. We'd give somebody starting out $1,000 credit card, and I would tell them, pretend like $300 is your limit. Don't go over that. If you can, 10% is a little bit better. If you can keep it below $100, that is better. If you can keep it paid off every month, that is the best case scenario. Your credit is a history of payments. It's not necessarily a history of balances. So you don't have to carry a balance on your credit card from one month to the next. You can pay that thing off every single month and not carry any revolving debt.
Okay. I've even heard that misperception or that myth. It's healthy to carry a balance. How do you feel about that?
I don't believe so. I think there's nothing wrong with it. Life happens. Sometimes you need to put a charge or something on a credit card that you're not able to pay off in a month. If you have a death in the family and you need airline tickets that weren't built into your budget, put those on your credit card and spend the next couple of months paying those off. But you don't want to uh, use your credit card to supplement your monthly spending. Um, that's worst case scenario.
Interesting. Yeah. Well, we'll dive into that in the budgeting part of the financial curriculum here that we're doing on the podcast. Yeah, income versus expenses, outgoing versus incoming.
Right.
Nice. Okay. You had mentioned too the regulating organizations, the I don't know what to call them, Experian, TransUnion, those people.
Credit bureaus.
Credit bureaus. Thank you. It's been a long morning. Credit bureaus, and they calculate credit scores the same.
The version of credit scores that most people are familiar with is the FICO score. And that came out years and years and years ago. All three main credit bureaus adopted the FICO score, and that's what people got used to. But FICO gets a royalty every time that score is pulled, and so the credit bureaus try to come up with their own versions. So, for instance, TransUnion has their Vantage score that it's very similar, but some things, even among the Vantage score, there's some that are auto enhanced and things like that. So every credit score that gets pulled is just about a little bit different. They should all kind of be in the same range, but I wouldn't expect to pull my credit on something like Credit Karma or something like that, and you can't expect that that's going to be the same score that gets pulled by a lender.
Interesting. Man, you just made me think of a lot more questions.
Let's dive into them.
Yeah, let's go. The How do you balance that then? So, if you're getting three different credit scores from three different credit bureaus on a consumer, how do you handle that?
So we're generally not. For mortgages, we do get we get all three bureau scores for that. It's a tri-merged report. And sometimes the credit score is a little bit off between the bureaus just because a lender will only report to one bureau. So sometimes that throws off the score a little bit, but we got rules in the real estate department of how we look at those scores. On the direct side and indirect, when we're doing the consumer lending outside of real estate, we're only pulling one bureau. So we pull the one bureau, we trust that score, and it's really just our way of standardizing the scores that we're getting across the membership.
Gotcha. Okay, so you're just looking at one. Okay, that makes a lot of sense. And if you're looking at one, then I'm assuming you trust their version of credit, their combination of character and payment history.
Right, right. Like I said, they're all very similar. So we do trust the one we did. In fact, when we switched over to it, we were running it alongside FICO, and the average difference was 20 points or so. And then sometimes it would be 20 points higher, sometimes it would be 20 points lower, but it was always right in that range.
Okay. And that's really just like you said, you're standardizing the process. So you're
Exactly.
comparing apples to apples instead of apples to oranges when there's two different consumers who come to you asking for a car loan.
Right.
Gotcha.
We will pull the other credit bureaus if we have a reason to. There's, again, like I said earlier, there's some lenders that only uh, report to one. Usually, it's your small town banks or things like that. And so, if we are looking for a vehicle that someone's refinancing through Wise Credit, which is a local institution here up in Wise County, they only report to one. So that's one that uh, we go looking for that one by pulling another bureau.
Gotcha. They only report to one. So what are we reporting to credit bureaus?
We report to all three of them.
All three of them?
Yep.
Okay. And we're reporting
All the information for the loan. I mean, it's the open date, the payment history, the loan size, the loan term, the payment amount. And then if there's any sort of delinquency or anything like that, that shows up on the credit report. Um, there's truncated account numbers on there and things like that. It's quite a bit of information that gets reported.
Gotcha. Okay. What can somebody do to improve their credit? We see all the time places like Credit Karma or these other things that are like boost your credit,
Hmm.
Are they offering a product, or are they just basically telling you, hey, do these, be disciplined to do these things for 6 months and it'll improve your credit score?
Yeah, I think that being aware of where your credit score is and how to improve it is going to be what those credit karmas and things like that are really um, trying to get you to do. If you have no idea what your credit score is, then when you go into the dealership to get an auto loan, um, you have no idea what rate you qualify for. So anything they put in front of you may be uh, what they're telling you that's the best rate available, but you have no way to even know. So
Do some homework.
do some homework. You just want to make sure that you are well aware of what's on your credit, and more importantly than that, that what's being reported is accurate.
Oh, interesting. How do you fix a mistake on your credit report?
Got to dispute it. So one of the ways to view what's being reported to your credit, you know, the government has made it to where you have to have access to, we have to allow access to your what's being reported to your credit. So annualcreditreport.com is where we send people. You can go there, and what we're pulling on our side is an abbreviated, condensed version of your credit report. But what you find on annualcreditreport.com is very drawn out information about every creditor that says that you've ever owed them money. And it's going to come with their full name, their address, a phone number to contact them, and everything. So if there is something on there that is not yours, then you'll want to dispute that.
Okay. That website one more time, annualcreditreport.com.
Annualcreditreport.com.
Gotcha. And we get one free credit report a year. Is that what you said?
That's it. And you're not going to get a score. You're not going to be able to tell what your score is there, but that is where you're going to be able to ensure that the information being reported is accurate.
Gotcha. And that leads to the next question of, we get a lot of those, like if you have a credit card or if you have a loan or you have it somewhere, they're like, hey, we know your score. Monitor your score.
Mm-hmm.
Monitor your credit score. How accurate are those?
It's kind of along the same line. A whole bunch of different models that could be pulled. It's probably going to be in the range somewhat, but you can't take it down to it's going to be that's going to be the exact number that's pulled if you go get your credit pulled somewhere. It's just never the case.
Gotcha. It's not a real time reflection of your credit score. It's a kind of a range. Hey, we know that over the past several months it's been here, so we're guessing it's here. But if you actually go pull your credit, it might be different.
Right.
Gotcha.
They're going to tell you that that's the most accurate score out there, the one that they're showing you.
Yeah.
Everybody feels like they got the most accurate thing.
I bet you there's some fine print somewhere
Absolutely.
along there. You might want to pay attention to that. Nice. Okay. Nice. Well, what tips or tricks or advice would you give somebody who's applying for any type of loan?
I don't know if tips or tricks or anything are going to get you anywhere. Really, I mean, stability is the biggest thing. I mean, we just want to make sure that you're not asking for something that you're not going to be able to afford. You know, we want to set you up for success. We don't want to set you up to fail. So that's when, you know, if we have someone getting their first car and they're trying to get a luxury vehicle and it's, you know, a $50,000, $60,000 car for someone just out of college getting into their career first job ever, that's it's probably not the best move. You know, you're making a decision over the next 5 or 6 years. You should probably get a little established before you make that kind of decision. So um, someone who's I think just have all your ducks in a row, I guess.
Yeah, no, I think that's exactly right. I mean, I think that's what we're learning out of this talk is, hey, start slow.
Hmm.
Baby steps, build that history, build that character, build that credit. I think I'm going to start using that a lot with my kids. Build that character.
Yeah.
Credit will come by just doing the right thing, but the stability and the payment history that builds your character is pretty important.
Right.
So
And honestly, I can't say it enough. Your relationship with your lender really does matter. And you can start that with your kids.
yeah, well, I like that, and I've harped on that quite a bit. Your relationship with your lender. Explain what you mean by that.
If you start your account at a young age, and you're learning how to responsibly handle your checking account and you're putting money in savings, and we can see that. Like I said, you know, your credit card or your checking account is your credit with us before you get credit. So when we're looking at giving you your first credit card or something like that, we're looking at your checking account. Are you taking your account negative every single week and allowing or forcing your check to bring you back positive? You know, and kind of depending on that check to bring you back positive every month, or are you managing your expenses and putting money in savings and your account is building and um, all of those things matter a lot.
I think that's one thing that we're definitely trying to accomplish with this personal finance podcast and with a lot of our marketing is like, hey, we're here to be your coach. We're here to be a guide on your financial journey. So we want to help you from square one because we know that square one leads to square two, and
Hmm.
square two leads to square three. So we want to put you in a position when you hit square four, when you're looking for that mortgage, when you're, looking for that personal loan to pay for your kid's wedding, right? Or
Absolutely.
college or whatever it is. We want to set you up for success so we can tell you yes
Hmm.
when you get there. That's what we really want to do. So, and that's a big reason for this podcast and a big reason why we're talking about finance and trying to make it personal because we want to bring it down to the level of, hey, we're here for you. And this is what we do, and this is how we do it. So, certainly grateful to Jared for your time. Before we go, anything left? Is there anything you want to mention or throw out there?
No, I think we covered just about everything I was thinking about.
Yeah, yeah, did a great job. So certainly appreciative of your time. I'm certainly grateful for what you do for the credit union, your leadership in that area. And if you ever have any questions or any thoughts, definitely reach out to Jared's team. He can help you along the way. And you do get out into the community every so often, and do some teaching or some seminars or webinars or sessions, right, on lending.
Yeah, me personally, not necessarily. I may step into that a little bit more and more, but we have real estate loan officers that go and they talk about the DACU lending program, and um, yeah, we have people in our public relations department that go to the schools and talk about it. Our lending department, generally, we're here to make loans, so
Yeah.
we're answering the phones and and trying to get those loans on the books.
We'll leave it to the professionals.
Right.
Gotcha. Yeah, our community relations team could come talk to you about personal finance and financial literacy, all that fun stuff. So, well, thank you very much, Jared. Certainly appreciate it. And we might in the future dive into some more specific uh, podcasts about home loans and auto loans and all that stuff. But this was a great place to start. Certainly grateful for your time. So, thank you, and see you on the golf course.
Yeah, it was a pleasure. I'll see you
Yeah.
there.
Yeah. Awesome.